Thank you very much for having me here and thanks for the introduction. My name is Olivier Trecco. I'm the head of ESG solutions at S&P Global Sustainable One, covering Japan, ASEAN, and Pacific countries. I'm extremely honored to be present today at this event organized by Stock Exchange of Thailand and to be speaking to you about ESG investing, market landscape, and opportunities. Now, before I start, as everyone knows, there has been a lot of discussion around the concept of ESG recently. Perhaps it could be useful to start by looking at it from a slightly different but very simple perspective. At its core, ESG, we all know it's environmental, social, and governance, but really it means that corporates are exposed to three sets of risks and opportunities. One, based on the location of their operation, exposure to physical risks, biodiversity, political risks, and etc. Two, based on the way they operate, their governance, their gender policy, etc. And three, based on their actual production. In other words, are the products and services aligned with underlying forces in society? And when those forces are related to the global notion of public good, education, climate, nature, we can talk about impact. So it matters because such forces can eventually get priced in by regulation, typically through carbon tax, or can be transformed into new consumers' preferences, for example, through the choice of a greener savings plan. So it matters because those two factors of regulation, evolving consumer preferences, impact is now at the heart of a company's business plan. And for this, S&P Global has all the relevant data. To name a few, for location, we have advanced geolocalized physical risk analysis following our recent acquisition of a climate tech, TCS. We also have developments in biodiversity metrics based on our partnership with United Nations Environmental Programme, WCMC. For the way companies operate, we have ESG scores and the Corporate Sustainability Assessment, the CSA. For impact, we offer SDGs, taxonomy data sets, green bonds, of which a bit later. And this is why S&P Global has launched Sustainable One, of which I'm part, and Sannya as well later today, to create a common voice in the market and bring together the wealth of ESG and financial expertise across the S&P divisions into a single access point for our clients. But let's start this conversation where it should, with science. The heart of the current sense of emergency with ESG investing is that there is an absolutely clear scientific consensus that business as usual is slowly making and increasingly fast making our planet unlivable. The human-made and human-felt cost of disaster is huge. We have ice swelling, sea level rising, crops failing, pushing people into poverty. We have doubling rates of natural disaster. So through all these, we have, let's say, two main important frameworks. The first one is the IPCC, which is the global consensus on scientists, saying that to avoid worst case scenarios, we need to not limit our temperature rise to 2 degrees, but to 1.5 degrees. This half a degree of warming makes a big difference. And that's the net zero target, right? Net zero by 2050 means trying to limit temperature rise to 1.5 and not 2 degrees. The other one is through the IEA, the International Energy Agency, which is actually providing those, also providing those scenarios, and which are, very useful for any science-based assessment to arrive at net zero by 2050. In all of those scenarios, we observe tremendous growth in renewables. We observe many opportunities, on electricity generation, solar, hydrogen, of which again a bit later, and a rapid shift away from fossil fuels, decarbonization pathways, of course. Okay, so this all matters because at the end of the day, timing is critical. What counts is the total carbon budget which is left for a sustainable world. According to IPCC projections, which I mentioned earlier, the total carbon budget left in order to maximize our chances to limit global warming 1.5 degree by 2050 was 300 gigatons of CO2 in 2020. Now we are in 2022. In 2021, we have consumed more than 30 gigatons. So now we have about, actually, that's the figure you see here. We have about 270 gigatons of CO2 left if we want to respect that budget, which allows us to reach 1.5 degree target. And that's why timing is critical, and that's why there's such a sense of urgency. The later we start our collective decarbonization journey, the more radical we need to be if we still want to reach that target. So that's the figure you have on the right on your screen here. If we had started in 2021, you would have the annual decarbonization rate globally across the planet would have been 10%. So globally, the whole planet would have had to decrease rate of would have had to decarbonize at a rate of 10% per year until 2030. But the more we wait, the more we have to increase our rate of decarbonization. If we start in 2025, the annual rate is minus 18% per year. And now, obviously, because this budget has to be respected by 2030, if we start in 2029, we need to have, and that's the yellow line, we need to have a drop of minus almost 100 immediate radical decrease in decarbonization. And that's what we call the net zero wall in a way. That's the sense of emergency that we are facing in a situation where action has to be done today. So this, of course, has been reflected by commitments from countries, growing numbers of countries committing to being carbon neutral by a defined time horizon, can be 2050, 2060 in some cases. So even though such commitments, as you can see on the right-hand table, only cover 40% of the world population, they do represent slightly more than 70% of the world's CO2 emissions. So we already have that, we're moving in this direction with a good balance between advanced economies, emerging markets, and developing economies. In parallel, what we observe is also, commitments from the financial sector and the corporate sectors. So we have from asset owners to banks, to financial services providers, ever increasing numbers of companies committing to reach net zero greenhouse gas emissions by 2050 or sooner, all under the umbrella of the Glasgow Financial Alliance for Net Zero, which represents trillions of dollars of assets. So now with all these figures, the scrutiny is actually on the actual disclosure of those targets and the quality of those targets. And that's, unfortunately, that's what we observe. This is based on very recent S&P research that was published in our yearbook this year. We observe that many companies may be setting targets that actually fall short of what's needed under a 2-degree climate scenario. What you have on the pie here is that about less than half of companies are actually aligned with an actual science-based 2-degree target for those who have actually committed. I would say even in a way a bit more concerning is that in our assessment based on our own CSA ESG score questionnaires, we see that only 42% of the companies that we gather data from report on at least one source of scope 3 emissions. So just to give a brief reminder of scope 3 and why this is important, we might all know what scope 1, 2, and 3 is, right? Scope 1 is the emissions which are generated by the company itself as part of its production process. That's the direct emissions. Scope 2 is the emissions that are generated by the electricity used, so the electricity company or the power company that is used to fuel the production process. And scope 3 is everything else, right? Scope 3 is the value chain, the upstream value chain coming from used by the company to produce its services, and the downstream is the actual use of the product by the company. And what you see here is that scope 3 is everything that is green, right? Light green, light green or dark green, which is upstream or downstream scope 3. And if you look sector by sector, scope 3 in most sectors can be up to 90% of the actual total footprint. So if we want to capture actual emissions and the quality of targets, we need to make sure that scope 3 is captured, because if you only capture scope 1 and 2, you might capture only a very small portion of the actual emissions generated by this company. So very logically, what this leads to is that at the current stage, and this is again based on recent S&P Global research, we see that all sectors that we analyze as for now, will fail to align with a 1.5 degree goal, right? So what you see here is the over budget, let's say, amount in terms of CO2 emissions sector by sector. So we don't see any negative number. No sector is under budget or creating more space for others. So we are in a situation now where that's why we see again this emergency where every sector, every company needs to act collectively so that we can reach and reach that 1.5 degree net zero goal. So that's I know it's not a very cheery way to start the discussion, but that's the situation we're facing today. Fortunately, on top of the commitments that we have seen so far, from countries and companies, there's also an ever-increasing list of reporting standards initiatives here to help companies structure the way they embark on this decarbonization journey, on this ESG journey, and to make it ever more science-based, scientific, and concrete. So I won't go into too much details about each of those, right? We are, you're very familiar with TCFD, which is the main, let's say, climate reporting standard today globally. GRI standards in Thailand are also very well spread. CDP, ISSB is the new accounting standard, which is trying to structure and introduce the ESG angle in the IFRS frameworks, and so on and so forth. The latest one is the TNFD, which is trying to do the same thing for nature impacts that the TCFD is doing for carbon. I won't go into too much detail about the principle-based initiatives because I'm aware of time, but I really wanted to spend a bit more time on the specific situation in Thailand, right? So actually, it's actually quite heartening to see that in very recent research that was published by GRI and NUS University in Singapore on the state of climate reporting in ASEAN, we see that Thailand actually comes on top, right? Thailand has, by far, I would say, the highest rate of climate disclosures across all platforms, GRI, TCFD, you name it, but any kind of disclosure is coming ahead of Malaysia, Singapore, Indonesia, Philippines, and Vietnam. So that's a very good and very progressive situation, which is very comforting, very reassuring, for all the reasons I mentioned earlier. Obviously, this is a situation because we see that, since 2022, there has been obligations for PLCs to report their ESG performance via Form 56.1 report. SCT has announced last year support for the TCFD framework format. So there's a global support where we see Thailand leading the way and SCT leading the way here in its support, which is very a bright light, I would say, in this situation. And of course, more needs to be done. We need to reach the 100% disclosure, and then see translation from disclosure to actual impact. So that was a kind of brief landscape description, both from the science and more from the reporting regulatory side. Now I wanted to move to the opportunities, right? We have a very, it's very clear plan for this discussion. So given that we have all that, we have the situation where there is this emergency, there is also a need to have return, obviously, right? So how do you conciliate those two situations? How do you make the most of a new status where you have to identify opportunities in line with climate ESG objectives and still meet your returns? One way, usually the first way is ESG integration, right? So integrate ESG factors in your investment process. Here, I've put as an example, the ESG scores that S&P is, putting together. We have a very specific questionnaire, which forms our corporate sustainability assessment, which is very thorough. We have over 1,000 data points that we collect. Most of these data points are private information directly submitted, so not publicly available information directly submitted from companies. So it's very detailed, very in-depth about all three angles of environmental, social, and governance. And what's interesting as well in this ESG score, and which is not always the case across the board, is that we try to infuse a double materiality dimension, right? So it's not only the risks that those companies that you invest in would uh, um, those companies would would be exposed. So the risks, let's say the risks faced by those companies, but it's also the impact on the environment and on social norms that those companies might have, right? So you have both sense, the risk one way and the impact the other way. Just a quick slide here to show in terms of opportunities that, you know, it's been an eternal conversation as how to reconciliate ESG and returns, especially in this economy. So here it's obviously, you know, full disclosure as always, you know, past performance is not a representation of future performance, but it's just a back test of our S&P 500 ESG index performance versus the S&P 500 normal, not non-ESG. And you see that over the recent years, there has been a slight overperformance from our ESG index compared to the non-ESG. And all the while, you know, that the difference, what the figures you see below, the plus 19%, 15%, these are the score increase of the index versus the ESG index versus the non-ESG index, right? So you can, it is possible, it has been possible. Again, this is not an assessment of future performance, but to marry increased ESG performance with increased financial returns. A few words very quickly on private markets. We also see so far, you know, the points I've mentioned earlier was about public markets. We also see that one of the most pressing concerns that we see currently from clients is coverage, and in particular, unlisted assets. The rise of private markets is forecast to grow to make up more than 10% of global AUM by 2025. In this context, we face growing demand for, you know, such scores, such CSA, you know, questionnaires tailored to non-listed micro nano cap from clients like private equity firms, private companies, and so on and so forth. So there are ways to collect this information in a lighter format with less data points in order to still capture the key ESG elements of those smaller companies. So what I've mentioned so far is, let's say, is this usually one of the first steps to capture opportunities is to integrate ESG aspect. Another one is to base the analysis on forward-looking assessment because of what I was saying earlier. You know, we are in a world of moving normal. You know, the new normal keeps evolving, and it's ever more important to keep in mind the fact that we are moving in a world where climate in particular is going to present ever more threats and opportunities. And in light of the net zero general framework, which we see is becoming the overall main narrative, in terms of opportunities, it's not really so much that we speak about net zero opportunities. It's more about how do you identify opportunities in a net zero investment framework. And that's really where we are, we see a lot of interest, a lot of questioning, a lot of preparation work from all kinds of stakeholders, from financial, from non-financial corporates, and so on and so forth. So that framework is really based on that, let's say that arrow that you can see here. The first step is always to quantify the baseline in order to identify, at the end of the day, it's a budget question, right? So you need to know what's your available budget, and to know your budget, you have to know how much you own today, how much GHG emissions you are responsible for today, scope 1, 2, and 3 across the entire value chain. So that's the baseline. And then you start going into forward-looking assessment, measuring the alignment of that portfolio or of your activities with various temperature increase scenarios. That's the step 1. That's looking at the impact that might have. So it's more on an impact basis. The reverse is looking at the risk dimension. So looking at how is your company or your portfolio exposed to emerging risks. So you have two types of main risks. Now we'll detail them a bit more in a second. Transition risk, the fact that we might live in a world where regulators are going to factor in carbon pricing increase to incentivize for emission reduction. So that's transition risk. We transition to a carbon efficient world. So carbon will become more expensive, and the more your activity is dependent on carbon, the more you are exposed to losses on that regard. The other type of risk is, in ways, the complement is the physical risk, assuming that nothing is done and we move to a worst case scenarios as identified by IPCC, for example. What is your portfolio or your company activities exposure to increasing natural catastrophes, which are of which ASEAN in particular is extremely exposed to, hurricanes, floods, droughts, and so on and so forth. So that's the key framework. And then from there, you are, the framework is to set targets, like net zero target by 2050 with a midterm target by 2030 and so on and so forth, and to report progress on that target. Those targets must be science-based, must be substantiated scientifically, and then reported upon. And that's the framework. And then from there, financing your ambition through indices, actual net zero investments, opportunities, technology disruptors, and so on and so forth, which will allow you to further reach your target. So a couple of slides now on what I just mentioned before, which is really today we see at the heart of this, how to navigate investment in this new world of net zero, right, and of rising climate crisis. The first one is transition risk. So just to go into slightly bit more detail about what I mentioned, what we're looking at here, and that's something that S&P Global Sustainable One is happy to provide to its client, is looking at the difference between the current carbon price, so that's the red section in this small chart here, and the expected or projected, should I say, future carbon price across different time horizon. It could be 2030, 2040, 2050, and so on. And that difference is the carbon risk premium, right? Is how much your company or your portfolio is exposed to if regulators were to enforce and regulators across the world, across all your activities, were to enforce carbon pricing initiatives or taxes and so on and so forth. And what would be the impact on your financials if that would happen? And on the financials of the companies that you invest in. Similarly, so we have different, similar approach, but different, let's say, methodology for physical risk assessment. Here it's looking at, because it's, physical risk is not a jurisdiction-based analytics. For carbon price, you're looking at regulator potentially deciding to increase price of carbon tax, and so on. For physical risk, you need to have a very detailed geolocalized assessment of the companies that you invest in or of your activities. So looking at, if you are investing in a company, you don't want to just look at where is the company headquarters located, but where are each of the plants and each of the production units of that company localized across the world. Are those plants, potentially affected by floods, by hurricanes, by droughts? Do they have difficulties if, drought, are they dependent on water intake, and so on and so forth? And once then, that's the strength of S&P Global, that we have an extremely detailed geolocalized asset database that allows us to marry those assets, physical assets, with latest IPCC, so science-based climate scenarios, in order to arrive at an estimation of potential loss, financial impact on those companies, looking at all those various projections, 30 years from now, and all the way to 2100. So that's, I would say, the foundation of today. Looking, when we speak about opportunities, we tend to think the reflex is to say, okay, yeah, hydrogen, and what is the latest tech. But really, the heart is just going through the bulk of the activities, the bulk of the portfolio, and looking at who is really exposed today and who is is in a better capacity to actually face that emerging society that we are entering in now. Now, just to have, I believe, about 7 more minutes, which is more than enough to finish my presentation here, because I also obviously wanted to talk about impact. So I just mentioned that the foundation stone is to have the baseline to look at your vulnerability exposure of your investments, but then we also need to look at how do you ensure impact now? How do we go one step further? How do you make sure it's not just a disclosure, not just making sure that you have assessed your risk, but how do you take into account and contribute to a better outcome, still meeting your financial objective, right? That's still always the framework. So we have today 4 main frameworks that we observe that clients and stakeholders are working with. The first one is the taxonomy framework. So I put here EU taxonomy alignment because the European Union taxonomy framework is the first one which is finalized and is effective and is being used today in Europe. So it's a list, in a way, it's a screening list of activities which are recognized as green, right? And one way of looking at impact is looking at how much of that company that you invest in, how much of that of its activities are actually aligned with green taxonomies. Obviously, this is an EU-based taxonomy. We are very closely following developments across Asia. ASEAN, in particular, is very active in developing taxonomies, and that we expect that would have a very strong impact. The other one, traditional impact framework, is the UN-based Sustainable Development Goals, SDGs, which is a list of 17 globally approved objectives in order to, I just put it back here, to reach for the good of society, right? Zero hunger, zero poverty, reduce poverty, clean water and sanitation. Usually we look at goal 13 here, which is climate action, where we see a lot of what I just mentioned fall in. So there's also a very strong interest in looking at it as how activities and the company's activities actually also align, contribute, or on the contrary, threaten each of these goals. Very quickly, the rest of the set of impact framework we see is the first one is green bonds. Green bonds have a very specific set of bonds which have as an objective, direct objective, to reach a green impact. So they have a use of proceeds limitation. So there's also a very dedicated set of metrics to analyze how those proceeds and how those investments allowed by these green bonds, to build a solar energy factory and so on and so forth, are used, and how do they contribute to global goal. Avoided carbon emissions is a typical way to look at this. Finally, I just wanted to quickly mention SFDR. SFDR is another EU-based regulation, but again, this is in this respect, the European Union has taken a bit of an advance because they have already put forward that regulation framework, which dictates how disclosure, sustainable disclosure, should be done. And what's interesting here, there's so much to say about SFDR, but what's interesting here is that for me, this is kind of the complement of the taxonomy approach. The taxonomy approach looks at what's green in my portfolio, how much of the revenue of the company in my portfolio is green. The SFDR is looking at the opposite. What's brown, in a way, right? Because these 18 indicators that you have to report on are called principal adverse indicators. So these are impact, right? But adverse impact. So how much are you affecting, hindering the objective of sustainable goals, right? So that's also a very useful set of indicators, even beyond the traditional, the pure EU obligations. Finally, as I mentioned, I had to finish with the disruptors. What we assume initially when we talk about opportunities, we think about, oh yeah, let's invest in clean tech, in energy transition, green hydrogen, vehicles, all these discussions. This is obviously very strong. It's very complex as well. We are very happy. S&P Global is, as Nisha mentioned earlier, is an organization that has several different specialties. In this case, S&P Global Platts, or Community Insight, as it is known today, has very good insights in those markets, voluntary carbon markets, hydrogen, and so on and so forth. And in order to enable participants and investors to identify, the good risk opportunity balance. And that's my final slide. I just wanted to finish with this one. At the end of the day, That's one way of looking at it, at investment, right? Total value. What we're looking at is you have to add beyond the pure financial impact to look at return. What the world we're going into and is looking at the overall assessment. So trying to quantify not just the financial return, but the social return and the social cost and the environmental return and environmental cost. And that needs to be able to have that actual net impact, which gives you the proper way to assess and identify an opportunity in this world. You need to rely on a very vast dimension of metrics, of data, and have a very clear view of what you are looking to do, what are your objectives, what you need to achieve, because depending on the objective, depending on the framework, you might have different metrics to assess impact. So there's not just one way of assessing. I'm not saying total value is one way, but I guess that's the main message I wanted to give is that there are many ways to identify opportunities, to identify impact, and it's a journey, it's a discussion. It's all of this is rapidly evolving, and this is an area where we are very happy to keep supporting you and engage in discussions. I will stop here. I think I have finished my time. Thank you very much for your attention, and I will be happy to take questions later.
Yeah, thank you, Olivier, for sharing the insight. And just would like to quickly open the floor. If there's any question, Olivier will be happy to take all your question, comments, if any, before we moving to the second section. Okay. Yeah, look like there's one question. So other than climate change, is there any hot topic related to ESG that investor is talking about right now?
Outside of climate change, I mean.
Yeah, other than the climate.
I mean, it's obviously so here. That was I only had 30 minutes, so I did focus a bit on the climate emergency. Obviously, when we talk about ESG, there's a tendency to forget about the S and the G dimension. The social and the governance. So, and this is something we are very attentive about here. So the social aspect and the governance are extremely important. Are discussed, and there's actually right now a reconsideration of those dimensions. So I would say those aspects are equally important. And I would also mention nature. Biodiversity is clearly becoming the net zero. The net zero issue. Let's say what net zero was to 2021, biodiversity is becoming to this year. We're having the TNFD framework, which is finalizing now. We're having COP15 on this. So very, very clearly nature-based initiatives and reporting is very increasingly important.
Yeah, thank you. Yeah, I think this is something that TNFD is something new, is another framework. So we're happy to take it offline for those who are interested, and we can have a separate catch up.